Today, the badness of trade wars. Welcome to the Property Imperative Weekly to the 18th of May 2019. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to today's edition of our weekly Finance and Property Digest to the 18th of May 2019. This week, it's been all about the trade wars as the US bears down on China, a Bitcoin frenzy, first-time buyers and negative equity in the dying days of the election campaign, and the Reserve Bank of New Zealand putting the cat among ANZ's capital pigeons. And meantime, property values slide some more. Before we start, a quick reminder that next Tuesday, the 21st of May at 8 p.m. Sydney, we'll be running our next live stream event. Here is the link where you can bookmark the session. During the show, you can ask me questions via the live online chat or beforehand via the DFA blog. Links to the sessions and our blogs are both in the comments below. I look forward to your joining the show. Meantime, let's start with the trade wars. President Trump has escalated the trade war with China, and that wrong-footed nearly everyone. Now, despite hopes that an agreement ending the war, or at least putting it on hold, is imminent, several other scenarios seem possible. Even one in which the US, China and the global economy suffer a recession, and Australia, of course, will be caught in the crossfire. Trump upped the ante in the trade discussions with the Chinese last week when he increased the tariff on $200 billion in Chinese imports from 10% to 25%. An additional $50 billion in Chinese imports already have a 25% tariff. China then said that it would retaliate from the 1st of June with higher tariffs on many imported US goods. The higher US duties will impact more than 5,700 different Chinese goods that are imported. But it won't apply to goods already in transit to the US, only those that leave China on or after May the 10th. It can take more than a month for ocean freight from China to reach the US, effectively providing a grace period for further negotiations. No additional trade talks with China, however, are currently scheduled. Investor reaction to the surprising turn in the trade war has been so far modest, at least so far as stocks are concerned. They were down only a few percent from the record high set just prior to Trump's tariff hike. But Wall Street ended lower on Friday as continuing trade tensions pulled industrials and tech shares down, and the Dow capped a fourth straight week of losses in its longest weekly losing streak in 3 years. The S&P 500 and the Nasdaq suffered their second successive weekly declines after US stocks failed to fully recover from Monday's steep sell-off. Trade headlines overshadowed upbeat economic data. The University of Michigan's Consumer Sentiment Index jumped 5.3% in May to its highest reading in 15 years. And with 460 of the S&P 500 companies having posted first quarter results, 75.2% of which beat analyst expectations, this was the most upbeat first quarter earnings season for years. But trade issues hung over the market like a bad smell on Friday. The Dow Jones Industrial Average fell 0.38% to 25,764. The S&P 500 lost 0.58% to 2,859. The S&P 100 fell 0.54% to 1,267, and the Nasdaq Composite dropped 1.04% to 7,816. The Volatility Index, which measures the implied volatility of the S&P 500 options, was up 4.38% to 15.96. Of the 11 major sectors in the S&P 500, all but utilities closed in the red, with industrials and energy seeing the largest percentage losses. The trade wars may play out a number of different ways. The first is mostly noise, and the US and China will come to terms in the next few weeks. Chinese retaliation could increase the up to 10% tariffs that the countries imposed on nearly $100 billion of US imports to China to 25%, but it will end there. Given the rising cost of the economy and stock markets if the war drags on, and Trump's innate desire to deal, some say the odds are good that some type of arrangement will be struck by the end of the grace period in mid-June. If so, the economic outlook will not change meaningfully. US real GDP growth is expected to come in at 2.5% in 2019, and unemployment is expected to slowly but steadily decline through the year. Chinese growth would also not be impacted, with real GDP growth of 6.3%, and the global economy continues to grow at close to its 3% potential. But, and it's a real but, there is a real risk that an agreement is not struck soon. And as a result, tariffs remain for longer, perhaps to December. The higher tariffs will have a meaningful impact on the US, China, and the global economies. And there is a difference between 10% and 25% tariffs, in that while global businesses can navigate around the impact of a 10% tariff by reducing their profit margin, pass along some of the higher costs to their customers, and source their imports from places not facing tariffs, at 25% global supply chains will be disrupted, hurting business investment and manufacturing output. This would reduce real GDP growth this year by nearly half a percentage point to closer to 2%, and the Federal Reserve will be tempted to cut interest rates given the uncertainty and weaker growth. And Chinese real GDP growth will be reduced by approximately the same amount to just less than 6% this year. Although Chinese authorities may ramp up their economic stimulus to offset the trade war's ill effects, they have shown a willingness and an ability to use their considerable monetary and fiscal tools to support growth. But then there is a more serious worst-case scenario, and this is becoming, frankly, more likely. Here, Trump engages in an all-out trade war and follows through on most of what he has threatened to do. This includes putting a 25% tariff on all Chinese imports to the US, which comes to some $520 billion for the past year, about 1/5 of all imports into the country. And Trump also goes all out on the 25% tariffs on vehicle imports and parts. The rest of the world doesn't take this lying down and retaliates in kind to the US actions. The Chinese could jack up tariff rates on all of the just over $100 billion in US imports to their country, but more likely, China will have a non-tariff response. China could make it more difficult for US businesses to obtain regulatory approval for various business activities, or delay the time it takes for US goods to clear customs. It could even allow the yuan to depreciate further in value, as it did last year when the trade war first broke out. An even more extreme step would be to altogether stop buying US goods, like the Apple iPhone. Remember, the Chinese boycotted Japanese cars a few years ago in a spat with that nation. This leads to a global recession. The Fed will attempt to cushion the economic blow by cutting rates, and the Chinese will pump up monetary and fiscal stimulus, but these efforts will fall short. The length and depth of the downturn will depend on how long it takes Trump to call a truce. But given the fast approaching presidential election, it is difficult to imagine he would allow the war to continue much into next year. But we'll see. The yield curve is signalling a recession as more likely, with the 10-year bond sitting at 2.39 and the 3-month at 2.38. A flat yield curve signals uncertainty, and as we've discussed before, inversion tends to signal a recession ahead. The big and unknowable question at the moment is whether the massive QE programs have messed with this theory. We'll see. But net-net, we think a US recession is now more likely than previously. This week's Chinese data has been supportive of the market's view and President Trump's view that China will be hardest hit by the tariffs. Year-to-date annual growth in industrial production disappointed, deaccelerating to 6.2%, while growth in fixed asset investments also came in below expectations at 6.1% year-to-date. China will continue to stimulate its domestic economy to around 6%, and in the long term, they have the potential to develop more higher-tech, higher profit industries, which will support the national and household income prospects, and hence consumption. The Shanghai Composite Index fell 2.48% on Friday and 1.94% for the week, and it's off 3.5% in May. But this is quite different from the US. Not only will US corporate profits be hit in the near term by the tariffs and/or a need for US firms to reorganize their offshore production, but there will remain little reason to increase US business investment, with the cost of labor and the currency reducing their competitiveness, and the risk of further tariffs on US exports remaining in place. On the latter, another point of contention looms, with the US continuing to assess whether to impose tariffs on auto imports, potentially affecting trade with Europe and Japan, among others. Reportedly, this decision has been put off for 6 months, though the president's priorities do shift quite abruptly sometimes. The US dollar index rose 0.16% on Friday to 98.01, while the Chinese yuan US dollar slid 0.5% to 0.1445. Hi. Excuse the interruption, but if you are getting value from this post, please consider subscribing to DFA if you haven't already done so, or ring that bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. The links are in the comments below. And thanks for supporting what we do, it's really appreciated and makes it possible for us to continue to make more great content. The trade wars will also hit the Australian economy hard, as it is already facing some uphill trends, so let's look at the latest local data. As we discussed last week, the RBA has said that the employment data will be critical when determining the next cash rate move, so the April Labour Force Survey and Q1 Wage Price Index were the key releases for Australia this week. The April Labour Force report was mixed. The increase in employment was materially above the market's expectation, and as a result, annual and 6-month annualised employment growth remained elevated at 2.6%. Nonetheless, the unemployment rate edged higher again to 5.2% as the participation rate rose to a record high of 65.8%, but significantly underemployment rose to 8.5%, just 0.5% below its previous peak. Now, we've said that underemployment is a key indicator and signals the pressure on household finances. On this dimension, it seems that this is trending higher across most states, with notable moves higher in Tasmania and Queensland. In the year to April, unemployment fell 0.4% in New South Wales to 4.5%, and that's a national low. Down 0.3% in Victoria to 4.9%, and down 0.6% in Queensland to 5.9%. But this trend is shifting, with unemployment up 0.1% in the last 6 months in New South Wales, up 0.3% in Victoria, while Queensland saw a 0.4% improvement. And the Roy Morgan series continues to report much higher levels of both unemployment and underemployment, with the combined unemployment and underemployment rate for April at an astonishing 17.7%. Turning to wages, growth disappointed in the March quarter, with a gain of just 0.5% or 2.3% year-on-year. Wage weaknesses remain broad-based by industry and across the states, with Victoria the only state to experience a sustained, robust uptrend in wages growth. Trend growth in the public sector was 2.4% over the past year, compared with 2.3% in the private sector. In original terms, annual wages growth to the March quarter 2019 by industry ranged from 1.8% for construction and the information, media and telecommunication service industries to 3% for healthcare and social assistance. Western Australia recorded the lowest through the year wage growth of 1.6%, while Victoria recorded the highest at 2.7%. And the NAB Business Survey for April highlighted a further deterioration in the labour market should be expected in coming months. At -1, the survey's employment index now points to annualised job growth of just 1.3%, half the annual and annualised pace of April, and also below growth in the working age population, 1.7% per year. The latter indicates that the unemployment and underemployment rates will continue to trend up through 2019. By industry, the largest falls occurred in retail, manufacturing and wholesale in the month, though the decline was broad-based, with only construction and recreation and personal services holding their ground. Other details of this survey was also weak, with both business conditions and confidence below long-run average levels, and capital expenditure expectations in a downtrend. Retail, wholesale and manufacturing all reported weaknesses, although mining reported the strongest business conditions thanks to the high price of commodities. On consumer sentiment, the Westpac Melbourne Institute Consumer Sentiment Index rose slightly in May to 101.3 from April's 100.7. Note, however, that the May reading is below the April post-budget responses, which equates to an index reading of 104.3. The detail implies that the budget's tax measures and a strong expectation of rate cuts in coming months are supporting views on family finances, That said, they're still below long-run average levels. As it's time to buy a major household item, the labour market deterioration and continued house price declines pose clear risks to already weak consumption and to investment in consumer-related sectors. Consumer expectations for family finances over the next 12 months slipped 1.6%, following a solid 4.1% lift in April that reflected the tax measures in the budget. However, this component is also below its long-run average. And the index of house price expectations posted a 6.5% drop, partially retracing the surprisingly strong 11.9% rise in April. Price expectations have been particularly volatile in New South Wales in recent months, but have still improved slightly since the start of the year. In contrast, price expectations have been pared back in Queensland and Western Australia, the latter showing a particularly sharp fall into negative territory and a 2.5-year low in May. So to the property sector and home prices. Here, the falls continue and accelerated. So the CoreLogic index to the 16th of May shows that in Sydney, prices dropped in the last week by 0.39%, over the month down 0.72%, over the quarter 2.66%, and annually 11.2%, and from peak 15.2%. In Melbourne, they dropped 0.13% over the last week, 0.27% over the last month, quarterly down 1.90%, annually 10.1%, and from peak 11.1%. In Brisbane, they're down 0.07% last week, over the month down 0.2% so far, over the quarter down 1.29%, annually down 2.2%, and from their past peak 1.90%. In Adelaide, they dropped 0.06% over the last week, over the month 0.05%, over the quarter 0.42%, annually they rose 0.3%, and from their peak they dropped 0.7%. In Perth, they fell 0.13% over the last week, down 0.19% over the month so far, down 1.84% over the quarter, annually down 8.4%, and from their last peak 18.6%. And across the 5 major centres, weekly they fell 0.24%, over the month so far down 0.44%, over the quarter down 2.08%, annually down 9%, and from their last peak 10.7%. And looking at the annual movement, Sydney is down more than 11%, Melbourne down more than 10%, Brisbane down more than 2%, Adelaide just slightly higher, Perth down 8.4%, and the major 5 down 9% over the last 12 months. Auction clearance rates came in at 54% from CoreLogic on Thursday, but at 555 cleared auctions compared with 1,218 listed, things are still looking weak. Sydney reported 59% and Melbourne 55.7%, but remember that Sydney is 43% lower than a year ago in volume terms, while Melbourne is 50% down. It's hard to see how the spruikers can claim things are improving. HI released their quarterly Economic and Industrial Outlook report and made a plea for weaker lending standards to revitalise the residential construction sector. In other words, let the debt bomb get ever bigger. The State and National Outlook report included update forecasts for new home building and renovation activity for Australia and each of the 8 states and territories. Preliminary data suggests that the housing market has adjusted from a strong annualised rate of home building of around 220,000 homes per year this time last year to around 183,000 at the start of 2019. And given that the ABS series on lending for business and households, which came out this week, also reported a further decline in lending, we can expect more falls as the credit impulse dies some more. As the ABS put it, there were large falls in the value of lending for owner-occupied dwellings in season-adjusted terms in both New South Wales down 5.7% and Queensland down 5.3% in March, after rises in both states the previous month. Nationally, lending for investment dwellings also contracted further in March, with the series down 25.9% seasonally adjusted compared to March 2018. The level of new lending for investment dwellings is at its lowest level since March 2011. While nationally, there was a fall in the number of loans to owner-occupied first home buyers, down 0.5% in March. In a similar pattern to recent months, this fall was again much less than the drop in the number of loans to owner-occupied non-first-time home buyers, which was down 3.3%. We examine this data in our post, The Credit Impulse Under the Microscope, where we compare the annual and monthly data trends. There is little evidence of any sort of a bounce, which is why more from the construction, finance and building sectors continue to press for a loosening of lending standards. This is probably behind the Coalition's announcement last Sunday of a scheme to entice first-time buyers into the market with 95% mortgages backed by a government scheme. This is frankly a nutty policy, which will create the risk of people buying into the falling market and quickly risking negative equity. We discuss this in our post, Unnatural Acts as Advertised. And we also discuss the issue on the ABC and on 2GB. Links to those posts are below. We expect more unnatural acts to try to stimulate housing lending and so reduce price falls ahead, but we suspect this will be unsuccessful. Already, negative equity is a significant issue. As we discussed recently, more than 10% of households are exposed. The RBA Financial Stability Report showed that according to their data, 12% of households in Western Australia are in negative equity, if lower in other states. Now, Chris Bowen, the Assistant Treasurer, said during the week on ABC's Triple J, households would only lose money if you sell. I mean, sometimes lots of people go into negative equity when the housing market does fall. I remember when I was first in the housing market, I went into negative equity for a while. The market does come back. But as I said to Ross Greenwood on 2GB, discussing negative equity on the radio, experience overseas is that negative equity can haunt households for years, reduce their mobility, cost them higher mortgage rates, and lead to social distress. And in addition, banks are required to identify material risks in their mortgage books. And if the loan-to-value ratios rise, they must hold more capital. The APRA APS 112 document, which describes the capital approach, reveals the variations in capitals held by standard banks. As you can see, as the loan-to-value rises, more capital must be put aside. But this chart from the RBA shows that now even small rises in loan-to-value ratios will have a significant impact. This is because of the high distribution of loans just below the 80% mark, which were there to avoid paying for lenders' mortgage insurance. And now, as prices are in some areas down more than 25%, many are tipping into negative equity. Many households will borrow on credit cards or borrow from the bank of mum and dad to get below the magic 80%. Although note, some banks are now looking to LMI down to 70% LVR. Banks using the advanced method, where they run their own internal models, are generally applying state average movements to their portfolios, not down to a property level. This, in effect, reduces the impact of price falls. In fact, when prices were rising, portfolios were adjusted frequently to reduce the capital required to be held. Remember that capital costs. And allowing them to lend more again. Now the reverse is also true, and more capital will be needed. And in the latest round, ANZ reported 5% in negative equity, others lower, including CBA, who, in their quarterly update, see our post, CBA dances the downgrade jig. Their shares fell 0.68% on Friday to 72.83, having fallen hard after their announcement earlier in the week. They reported higher mortgage delinquency and more households in negative equity, and also a massive customer remediation program. And talking of advanced models, the Reserve Bank of New Zealand shook the market on Friday, saying it revoked ANZ Bank New Zealand's accreditation to model its own operational risk capital requirements due to a persistent failure in its controls and attestation processes. So ANZ is now required to use the standardised approach for calculating appropriate operational risk from March 2019, and this will increase its minimum capital held for operational risk by around 60% to $760 million. ANZ share price fell 3.04% on Friday to end at $25.85, down 4.75% over the last year. We suspect there will be more focus on these internal models because we hold the view that most of the major banks are actually not incorporating the impact of falling home prices adequately. These models are not well understood or fully audited, and the regulators tend to trust the banks. And as we saw through the Royal Commission last year, that worked well. And the case between ASIC and Westpac has been in court with a focus on responsible lending, whether it can be based on household expenditure measures, HEM. The judge will now consider the submissions. ASIC argued that HEM or other benchmarks are not sufficient to support responsible lending, while Westpac is arguing that it is fine, and currently there's nothing in the law to say that it can't be used. This could be a critical case, in that if HEM is found to be fine, lending standards may drop again, whereas if the judge supports ASIC, then you can expect more responsible lending class actions. We think the sleepers around negative equity, capital models and HEM will continue the pressure on the banks. The ASX 100 rose 0.55% on Friday to 5,246. The ASX Financials was down 0.9% to 5,823. And the local volatility index was up 4.17% to 1402, which is 18.8% higher than a year ago. Property stocks remain in the doldrums generally, but McGrath is an exception. It is down now more than 90% from its market listing, with its market capital falling to $35 million. It was up 2.44% on Friday to 21 cents, but is clearly, from an investor's perspective, a dog. And Yellow Brick Road announced a simplification of its business to focus on mortgages and mortgage-backed securitization whilst giving up on its broader wealth strategy. The ex-Macquarie CEO Frank Gannis will step down from his role, and Executive Chairman Mark Boris will now lead the restructuring of the group. YBR fell 3.03% on Friday to 6.4 cents, down 34.3% from a year ago. The Aussie fell further, down to 68.68, and has now broken through that 70 cent mark, and is already down 8.33% from a year ago. We expect further falls, and we know the Reserve Bank is happy to sacrifice the dollar, but of course will be importing inflation, and for example, we already know that oil prices are on the rise. That will put more pressure on households. The spot Aussie Gold Cross fell 0.37% to 1,860 and is up 8.69% from a year ago. The Aussie Bitcoin Cross fell 6.55% on Friday to end at 9,467, down 8.7% from a year back. Finally, back to the international markets. Gold futures for June were down 0.69% to 1,277. Elsewhere in commodities trading, crude oil for delivery in June fell 0.22% to hit 62.73 a barrel, and the euro US dollar was down 0.11% to 1.1159. Bitcoin had another interesting week, falling to 7,303 on Friday, down 6.6%. This may well be explained by a 5,100 Bitcoin dump that occurred on the Bitstamp exchange, which saw the price of Bitcoin tank more than 20%. And that flowed across to the other exchanges, taking the price down to $7,100. The Bitcoin price plunge caused altcoins to plummet as well, with most of the top 100 also dropping. This could also be amplified by a combination of profit-taking and algorithmic trading, both compounding the swift falls. Expect these types of steep rises and drops to continue for some time until institutional investors grow market volume. Despite the recent drops, some say the crypto markets as a whole are fundamentally stronger, and that's partly because trading can be now done through new gateways offered by the likes of Fidelity and ICE-backed. There is certainly more infrastructure now with custodian trading software and compliance software, but it remains unclear as to whether or not the current rally will ultimately morph into a long-term uptrend. It is still early days. It's interesting to watch the DFA audience, some of whom are preferring gold or silver, and others are Bitcoin disciples. Both routes have their pros and their cons. So standing back, we should expect to see more market volatility as the trade wars play out, and locally the housing sector will remain weak into winter. And we'll update our scenarios on Tuesday's live stream. There is nothing which has fundamentally changed our expectations. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.